Today, we're breaking down Chevron's massive third-quarter earnings call, and let me tell you, there are some game-changing insights here that every energy investor needs to know. We're counting down the top 10 takeaways, starting at number 10, and building to the most critical point. So stick around, because number 1 is going to surprise you. Coming in at number 10, let's talk about Argentina. Chevron has significant acreage in the Vaca Muerta shale formation, roughly the same size as their Permian holdings. They're currently producing around 25,000 barrels per day. But here's the kicker. With President Milei's policy reforms stabilizing the banking system and reducing capital controls, this asset could compete very effectively for capital going forward. CEO Mike Wirth compared it to their DJ Basin success, suggesting substantial upside potential. At number 9, we have Permian efficiency gains. While other operators are dropping rigs and cutting capital, Chevron just hit over 1 million barrels per day in the Permian. How? They've achieved a 40% improvement in drilling productivity compared to just a few years ago. Their manufacturing approach and steady execution allow them to continuously improve without the whipsaw effects smaller operators face when commodity prices fluctuate. Number 8 is all about cash generation. Chevron delivered $7 billion in adjusted free cash flow this quarter and returned $6 billion to shareholders. What's remarkable is this represents a 20% increase compared to the same quarter last year when crude prices were $10 higher. That's the power of their high-margin asset growth and capital efficiency improvements. Coming in at 7, the Hess integration is exceeding expectations. Legacy Hess assets contributed $150 million in the quarter, and Chevron is on track to deliver $1 billion in annual synergies. Yellowtail started up during the quarter, and Wirth emphasized how impressed he was with the quality of Hess employees joining Chevron, particularly the Guyana team. At number 6, TCO in Kazakhstan is delivering record performance. The facility is running at nameplate capacity with exceptional reliability, something that's historically challenging for new processing trains. They're now using advanced information technology to optimize routing across 3 generations of surface plants, and there's potential for capacity creep over time, similar to what refineries typically achieve. Number 5 reveals Chevron's structural cost savings program has captured approximately $1.5 billion in annual run rate savings. Their new operating model went live this quarter, organizing upstream operations around asset classes to drive best practices and technology deployment more effectively across the portfolio. At number 4, Chevron is ramping up exploration. After years of constraining exploration spending and focusing on near-infrastructure opportunities, they're moving to a more balanced approach. They've added new country entries in Brazil, Namibia, Nigeria, and Angola, with increased emphasis on high-impact frontier areas while bringing new technology and talent to bear. The bronze medal position at number 3 goes to record production. Chevron exceeded 4 million barrels of oil equivalent per day this quarter, driven by strong growth and high reliability across the upstream. They expect full-year production growth at the top end of their 6 to 8% guidance range, excluding legacy Hess. At number 2, the Bakken asset quality story is evolving. Chevron initially underestimated the DJ Basin's quality and was pleasantly surprised. Now, they're taking a similar careful look at the Bakken, which Hess built to a 200,000 barrel per day plateau. They're applying best practices from other basins and aren't rushing to make decisions about its long-term portfolio role. And finally, at number 1, Chevron's strategic portfolio mix. Post-Hess, they're back to 85% upstream and 15% downstream, which is where they've been for decades. Wirth emphasized they're comfortable with this weighting because upstream is a depleting business, while downstream faces capacity creep and challenging economics over the cycle. This intentional portfolio design combines facility-limited assets and unconventionals managed for flat production, reducing the massive capital investments typically needed to offset decline. That's it for today's breakdown. If you found this valuable, smash that like button and subscribe for more earnings analysis. What do you think about Chevron's strategy? Drop your thoughts in the comments below.